Well, now on paper, you have your revenue of 100,000, you have your expenses of 60,000, then you have this depreciation expense of 50,000. Now you're at a loss of $10,000. And this loss is only on paper. I started investing in multifamily, and that's really because it really just made sense to me on so many levels, from a philosophical level, if you will. Like real estate, there's a lot of technology disrupting the entire world right now. Things are coming and going. They're going to be here today and gone tomorrow. The reality of the situation is people always need space to live, space to work, whether that's at home or somewhere else. They need space. And until, we have Honey, I Shrunk the Kids technology, real estate, in my opinion, is not going anywhere. So it's going to be here today. It's going to be here, way after I'm gone. So I like the longevity aspect of it. I also liked the multiple profit centers, right? So you have appreciation. It generally appreciates over time. You can also in multifamily force appreciation through value add and increasing the NOI. So that was always very attractive. Then you have the tax benefits of it. So one of the best parts about real estate is you can effectively get your rental income tax free because of the expense called depreciation. So you could, in other words, you can have a tax loss for tax for on paper for tax purposes, but despite the fact that you're actually generating positive cash flow. So that was always attractive. And there's principal pay down. Then in multifamily specifically, you have economies of scale. Instead of having to go buy 10 single family houses, you can just buy one apartment complex in one transaction. It's a little bit more complicated than buying a single family house, for sure. But all that stuff, that's what attracted me to real estate, and also the stability of it for the most part. The stock market, it's very easy, to put your money in the stock market and it goes down, and you could watch that every day, and it can give you like, a lot of anxiety. So basically after 2008, I graduated high school. I'm going to date myself a little bit here, I guess, but I graduated high school in 2009. So I'm not that old, but the point is, like, I kind of came out of high school during that economic downturn, and everybody's so fearful of the stock market that kind of got into me too. So I was like, you know what? Real estate's on the up and up right now. It's on the upward trend. All the profit centers I just mentioned, that's kind of why I got into it.
Let's talk about taxes, since a little bit about the subject. How is it possible that you can make an investment? Let's say you invest $100,000 and you get cash flow distributions, you get $6,000-7,000 in a year, and you're showing a taxable loss, right? And the poor investor takes the K1 to his CPA, and the CPA goes, "Oh, so sorry, Tommy, that you're such a bad investor." And you're like, "No, let me explain to you." And it's something that's so unusual. Explain to me at a really high level how taxation of real estate works.
Yeah, absolutely. So the first thing to understand, I guess the first thing to understand is when you buy a property, you don't get to expense it the first year, right? So every single year, a portion of the property's building value. So land is never depreciated. I'm gonna get into depreciation in a second, but land is not depreciated. But your building's value will be depreciated. Basically, gonna have a depreciation expense each year, a little bit each year, and there's ways to accelerate that and increase that. But that expense is only on paper. That's not an expense that actually, it's not money that actually leaves your pocket. So that expense, because it's so large, because real estate's so capital intensive and you're buying these large properties, that expense is quite high in many cases, and it's able to shelter your rental income. So to kind of give an example, let's just say you had $100,000 in rental income, right? And then you have $60,000 of hard expenses. And what I mean by hard expenses, I'm talking about utilities, repairs and maintenance, legal fees. Maybe you're paying a leasing agent to rent it out, property management fees. All of these fees. This is money that actually leaves your pocket at the end of the day. It goes to somebody else. So if you took this example, $100,000 in revenue, $60,000 in hard expenses, you'd be left with about $40,000 left of income, right? Or cash flow. Now, in many other businesses, that's it. You just pay tax on that $40,000 and, you call it a day. But because the depreciation expense in real estate is so high, let's just say that you had $50,000 of depreciation. And the reality is it could be much, much higher than that. But let's say you had $50,000 for the sake of this example. Well, now on paper, you have your revenue of 100,000, you have your expenses of 60,000, then you have this depreciation expense of 50,000. Now you're at a loss of $10,000. And this loss is only on paper, because remember, this depreciation expense doesn't really exist. It's called a non-cash expense or a phantom expense, because now when you go report your tax returns, you're reporting this loss on your tax returns, but yet you just pocketed $40,000 in this example of cash flow. So you didn't have to pay tax on your cash flow. And that's just scraping the iceberg, or the tip of the iceberg in terms of tax strategies, is your ability to not have to pay tax on the cash flow.
Tom, so question, let's talk about what happens when so one of the big things that happens, you get into this, you get this bonus depreciation, and obviously, everyone can use it, but it doesn't work. You can't take, not everyone can take the full benefit of it. Maybe explain a little bit about who can take the full benefit of it, and how it works with the different levels of people. And then also what happens on with when it comes to recapture when we do sell a property.
All right, absolutely. So I'll break it down first for the people who can use it, right? So if you, first thing to understand here, just to lay the foundation of this, that Section 469 of the tax code, which was put into place in the Tax Reform Act of 1986, made all rental activities passive by default. And what that meant is that, and there's two buckets of income, basically. There's passive income and non-passive income. If you have a job or you have an active business you're involved in, your income is generally going to be in the non-passive bucket. Then if you have a business that you're not active in, or you have real estate, it's going to be in the passive bucket. So these rules state that passive losses can only offset passive income. So in other words, the passive losses from real estate can generally not offset your active income or your non-passive income. And that's where most people fall into the bucket. Now there's something called the real estate professional status. And the real estate professional status was put into place in like 1994, after pretty much over that 8-year period. There's a lot of lobbying by the real estate industry to get this put in place. And what it does is, if you work more than 750 hours and more than half your total working time, and that's the key, more than half your total working time, that's what trips a lot of people up, in a real property trade or business, then you can effectively take the losses from your rental properties against your active or your non-passive income and use it to offset and basically help reduce your taxes. So let's say, for example, let's just say you made $100,000 of income that was non-passive, right? And you're able to qualify as a real estate professional, or your spouse was able to qualify as a real estate professional, and you had this $10,000 of losses that I was talking about before from this rental property. Well, now this $10,000 of losses are going to be able to offset that $100,000 of income you have, and you're only going to pay tax on $90,000 of that. So if you were just, I'm pulling a number out of a hat here. If you're in the 22% tax bracket, and we could always add zeros to this and increases, but just for example, if you're in the 22% tax bracket, this $20,000, this $10,000 loss is going to be worth $2,200 for you. Now, in many cases, these numbers are amplified. I'm just giving an example. I see, for example, many of real estate investors are often saving $10,000, $20,000, $30,000 using this strategy, but that's just an example of how it works there. Now, if you're not a real estate professional, which is the majority of investors in my experience, then what happens is these losses cannot offset your active income, and instead they will only offset your other passive income. So maybe you own other properties that have passive income. They can offset the income from those properties, or the gain on sale of a passive activity. So when you sell a property, or if you're invested in like a syndicate and that property is sold, you can use these passive losses to offset the gain on sale. And that in and of itself is a big perk in real estate. So in my experience, a lot of investors really get, bummed out when they get to hear that, oh, I can't take this against my non-passive income. But then they start to realize over time, oh, look, you can offset your cash flow from it, again, your rental income, and then also the gain on sale when you ultimately sell a property can help shelter it. And that's really the benefit for those folks.
So Tom, I got one thing on this that I think sometimes there's this like gray area, or people are in these industries and they're not sure, hey, would I qualify for real estate professional status? So I'm going to call out a few of these, and I want you to tell me if they technically would qualify, or if there's a version that could qualify or not, because I think there's, and maybe I don't even know the answer to some of these. I'm not in these industries, but like, say for example, a mortgage broker. Would that person qualify for real estate professional status?
No, that person would not qualify because they're believed to be in the financing business, and there's a few tax court cases on that around that confirm that. So I'm 100% confident that a mortgage broker as unfair as it may seem, does not qualify as a real estate professional.
What about a real estate tax advisor?
Unfortunately not. So we would be considered to be in the accounting industry.
So, but a commercial real estate broker or residential broker.
Yes, and because there's 11 real property trades or businesses, and one of them is brokerage. And if you're an agent or you are a broker, then that would be considered a real property trade business for these purposes.
Oh, that's really good to know. Michael, go ahead.
Yeah, so you have these taxable losses while you're holding a piece of real estate, and then typically they will carry forward until such time where you actually sell something. Now, typically when you sell, you have this giant capital gain, right? And at one point you got to pay the piper, right? Or maybe
Right.
or maybe you don't. What are some tax and what you said is that these carry forward losses can be applied towards passive gains, such as when you sell them. And so you're able to consume those. But what are some other tax strategies that you see where if you do make an investment in a multifamily or commercial real estate and 4 years later it sells for a massive, capital gain, what are some options that investors can consider to possibly not pay taxes or defer taxes?
Right. So to defer taxes, so the first thing is it depends on your level of control over the deal. If you have control over the deal or you're on the management team and you want to go ahead and do a 1031 exchange, you can go ahead and do a 1031 exchange and basically take the sales proceeds and buy another property, usually a larger property or multiple properties, and you're able to defer the tax, continue to keep, accumulating more real estate and continue building your wealth. So the 1031 exchange, very classic. That's the first, that's one of the main options people consider. Now, the second option, this has been really popular over the last few years, thanks to bonus depreciation. And that is, say you sell that property is going to be sold, 3 years is going to be sold. Well, you can look at this form on your tax return. It's called Form 8582. And that's where your passive activity losses or your suspended losses that have accumulated are stored or just reported right every year. And if you look at that and you say, okay, well, I'm estimating this gain to be, $100,000, and I have $120,000 worth of losses on my Form 8582. Well, you don't need to do anything in that case. You just let it offset and you're good to go. It'll just automatically offset it. Now, if you don't have enough passive losses, you have a few options. You can go and invest in a property directly. So maybe you go out and buy your own property, have a cost segregation study run on it, and then you can use bonus depreciation or just depreciation in general to offset it. And I'll get into a little bit more about the bonus depreciation in just 1 second, because there's something that people need to be aware of around that. But that's one way to do it. Or you can go and invest in a syndicate. So you can go and invest in a syndicate. If assuming they're going to do the sponsor's going to do a cost segregation study on it, you can use the losses from the syndicate to offset the gain on the sale. Now, that the key to this strategy is that the property the new property has to be bought in the same calendar year, same tax year, which is the calendar year for most taxpayers, as the property is being sold. So that's why syndicates are so popular for this. I've actually did this last year. I was invested in a syndicate. It sold, and then I invested in another syndicate before the year end. I got the passive loss passed through, and now I'm not going to pay tax at the federal level, which is very nice. So that's one way to go about it. Now, something to note about bonus depreciation, it is starting to phase out. So 2022 will be the last year you're going to be eligible for 100% bonus depreciation. And in 2023, it goes down to 80%, which is still going to be quite powerful. We've run the numbers on it. Still packs a very powerful punch. And 2024 goes down to 60, still pretty good. And then 2025 goes down to 40%, and 2026 goes down to 20%. And 2027, under current law, it's gone. So something that a lot of people have been doing right now this year, and I'm sure they're going to continue doing it next year, is making their investments now. And the reason why they're doing it now, we're going to be planning to do it next year, is so they can lock in that bonus depreciation at those high rates, so that when they're syndicates or when they sell properties 2, 3, 4 years from now, they're going to have all these suspended passive losses.